Hello folks, by the title you have already understand what is this video is going to be. Yeah, this is episode 2 of ICT's 2024 mentorship. I'm gonna use the wizard version of that episode 2. So everything over here, that's my understanding. Make sure that you are not going to be confused by that explanation. So let's go to the video, but before going over there, make sure that you have given me the thumbs up and you have given me you have subscribed to my channel if you are new. I would love to say that 15-minute time frame, that should be your highest time frame if you are interested to learn ICT's 2024 mentorship. All the time I'm referring that 15-minute time frame. You don't need the higher time frame. Again, you don't need any higher time frame. That 15-minute time frame is the highest time frame you need for trading, for being a profitable trader. Okay? Now, I would love to summarize the introduction lecture of ICTs. It's near about 1 hour lecture, but I would love to finish this lecture by summarizing within 1 to 2 minutes. Okay. First, you have to find your personality. That means which PDRA or which setup is actually flexible with your personality. Maybe you are good to go for breakup block entry. Maybe you are good to go with inversion parabolic entry. It can be 22 YT model. It can be optimal trade entry, turtle soup, whatever it is. Just find it out first. Don't trade every single model. Be the master of one specific model. Okay, that should be your personality. If you think that most of the time you see the 22 YT model, it's very eye-catching for you, then be strict with that specific model. Don't just go here and there. That's the advice from ICT. Then you have to avoid the toxic people, the social media. Okay, there are a lot of people there stupid. They are going to tell you the negative things. Try to avoid them. And how you are going to avoid them? Just focus on your analysis. Just focus whatever you are thinking. Even if it is wrong, be strict with your thinking. Just don't get influenced by others people, because most of the people are the loser in this industry. So don't make yourself foolish by giving the priority of their thinking or of their commenting about your trading. Make sure that you are just avoiding that type of toxic people because they are stupid. Okay, and obviously the social media, because in social media you will always see that they are going to take the winning trade only, winning trade. Okay, that will demotivate you whenever you will take a losing trade. Make sure that you are avoiding those and instead you are actually depending on your analysis and on your own thinking. Obviously, you have to do the journal. That is the most important thing. And when you will do the journal, the last video, that means the episode 1, I have already shown you how to journal. And in this video, I am just going to tell you what you should think when you are doing journal. You have to be very honest over there. Okay, you can't just lie yourself, because this is for your own development. You have to be very honest over there. You have to encourage yourself. Okay, maybe you got a losing trade. You just don't need to discourage yourself. Instead, you should encourage yourself, because you are journaling things over here. That losing trade, after taking that losing trade, if you journal it and if you really study why that was a losing trade, you will learn. And when you will learn, at the end of the learning season, you are going to earn. So make sure that you are not discouraging yourself. Instead, you are actually encouraging yourself. Always avoid your negative thoughts. That means when you will take a losing trade, you can think that, okay, I took a losing trade, I am unable to trade this thing, it's not for me. Every single person actually think like that way at their beginning. I also thought like that way, that I'll never be able to trade, I'll never be able to be a consistent profitable trader. I was thinking like that way. So it actually slow you down for your growing or for your development. That's why always avoid your negative thoughts. Now, how can you actually avoid the FOMO? You have to avoid the FOMO by just knowing two things. First, where market is heading and when it is going over there. If you know that, then you will be easily able to avoid the FOMO. That means fear of missing opportunity. You can ask, brother, how can I know that where market is heading and when it is going to head to that specific area? Yeah, that's why you need the journal. When you will do the journal, in time you will build and confidence that will help you to understand where market is actually heading. And how you are going to journal, you please watch the first episode. I will just look over here on the right top corner. Here is the link. Just click on that. Over there, I just explained how should you journal in that specific video, because you have to watch that video as well, because that is the first video of this mentorship, and that is, though it is the introduction video, but it is extremely important. So please make sure that you have watched that video. So by journaling, you will be able to avoid the FOMO. And for avoiding FOMO, you need to know just two things, and that is where market is heading and when it is going to go over there. You need, a screen that can be a 15-inch screen. You need a laptop screen, not the mobile screen. This is extremely important to understand that. Some of you can think that, okay, I'm going to be study this price action from my mobile screen. Maybe that can be your tab. No, man, you are doing wrong. Though you are thinking that you are learning price action, you are, studying the price action. No, you are not doing that. You need a screen that is bigger than that, than your the mobile screen or the tab screen. That screen should be minimum 15 inch. So you need a laptop. That is obvious. You can't avoid this thing. If you don't have the laptop, I really don't have anything to tell you. You are just wasting your time. In my opinion, you are just wasting your time. So obviously you need a laptop at least. Now, if you don't have the live data, it will help you for learning. For example, if you are using this trading view, this is a green button. Okay, over here you see this is a green. So for that green signal, I have to pay trading view. When I pay the trading view, then they were providing me the live data. So this is the live data. Now, if you don't pay or if you don't take the membership of trading view, then you are not going to get the live data. But to be honest, at your beginning, that is going to help you. You don't need to buy the live data at your beginning, because when you will have the live data, simply you will try to trade the paper trade. In my starting of my live streaming, this is my opinion. Okay, I extremely told you guys that please don't push your button, at least not for 3 months. At least not for 3 months. Don't even push your button. Instead, just use that tool for your learning. It is going to help you to learn. If you push your button, you are just going to focus on the loss, stop loss and the target profit, which is extremely a barrier of your learning. That's why if you don't have the live data and if you don't cheat, that means, this market is almost similar of NAS 100, where you don't need to buy the data. It's not the same price action, but still you will have an idea where market is reaching for. If you don't cheat yourself, instead if you just use that data, though you are delay, but you are going to trade in live. Okay, yeah, you are late, maybe you are not here, so far maybe you are here right now, you are here, but actually market is over there, but you are here. In that area, you are not able to push your button. That means the paper trade also you are not able to push your button. So either way, you are going to get the live data. Okay, except you are unable to push the button. When you are unable to push the button, then you will simply avoid the thinking that I learned a lot, so let's try. Is this trade going to work or not? Then you will push your button, it will stop your learning process. That's why my opinion, and also ICT told, though he talked about his son, but I'm just telling you to summarize by by not having the live data, what is the benefit? In that type of situation, you won't force yourself to push your button. Instead, it will be easier for you to study the price action. Okay, without pushing button, you will study the price. Whenever you will see the setup, you will use that tool, and that will help you to study this price action for learning. It's my opinion. Okay, now around 7 a.m. I would love to mark the 7 a.m. first. Okay, so here this is the 7 a.m. So this line from that area. Okay, around 7 a.m. in the first video in episode 1, ICT told, or maybe I didn't understand. Not only me, lot of people didn't understand. That's why ICT actually make sure that we can understand what we should look for around that hour. So 7 a.m. is the starting of New York morning session. You are just going to think that there is no other price action. So before 7 a.m. there is no price action. You will start to look for relatively equal highs and relatively equal lows after that line, not before that line. You will start to look for that from 15-minute chart. You can see from 15-minute chart, from 5-minute chart, and from 1-minute chart. Now from 15-minute chart, as you can see, this is the high. No, not that high. Okay, not this type of relatively equal highs. Maybe this high and that high relatively equal highs. No. After 7, you will start to look for relatively equal highs and relatively equal highs, lows from all of the 15-minute chart, 5-minute chart, 1-minute chart. I'm going to use the 1-minute chart all of the rest of the time because I don't need that 15-minute chart at all for explaining episode 2 of 2024 mentorship, because ICT didn't use that 15-minute chart. So I'm going to use only the 1-minute chart. So I'm going to make it bigger. Around the 7 a.m. you will start to look for relatively equal highs and relatively equal lows from all of those time frames. Now, from 15-minute chart, you will see that there is no relatively equal highs. Not from 5-minute chart, you will get relatively equal highs from 1-minute chart. If you see this high and that high, they are relatively equal highs, right? So you should mark that relatively equal highs after 7 a.m., not before. And you see this low, that low, they are relatively equal lows around 7 a.m. I mean after 7 a.m. You have to mark both relatively equal highs and relatively equal lows. Now, here is another thing. If you are in advanced, obviously you can start to look for setup over here. If you are in advanced level, maybe you are studying ICT concept for 5 years. So you know what you are looking for. Everything is different for you. I'm just talking here for the beginners who are started learning ICT price action from 2024 mentorship. This is just for them. If you are in advanced level, I don't think so that you have to wait for this type of things. Maybe you can use the previous price action as well. But if you are brand new, this is just for you. Okay, so make sure that you are not confused in this time. Okay, in this area. So here you are not going to predict the setup. Never ever going to predict the setup. Instead, just wait to form the setup. If there is a setup, then react with that setup. If there is no setup, don't start to predict that setup. That means what I am telling. Maybe you saw this relatively equal highs, this high and that high, they are relatively equal highs, this is relatively equal lows. And then you saw that market went higher, right? It went above this relatively equal highs. So simply you are predicting that market is now going to fall. Take this, relatively equal lows. So what you have done, you are predicting the setup and you pushed your bottom over there. Don't do that. It is extremely important. Don't do that. Instead, you should wait for the setup. It is extremely important. Okay, don't skip this part. You know that market is going to fall after taking that buy side liquidity, but don't predict it. If you get the price action, then participate in that specific price action. Now, all you can see after that tagged, this buy side liquidity has tagged, then market fall to that sell side liquidity, then market fall again, right? It came until that area. When it came until that area, after coming to that area, you will start to mark every CB. You are thinking that market is going to fall because around that area market has taken the buy side liquidity. Now market fall again. You are thinking that by anyhow, you are thinking that market is actually falling. How do I know that? Now ICT didn't he didn't clear that by this video. Maybe in time we will understand why we should think that market should keep falling. When I'll be here around that area, yeah, I will explain some things where you can use some information over there when I'll be around that area. But right now, maybe you are here, so you don't know what is going to happen next around that area. You are just around that area. You don't know what is going to happen next. In this type of situation, you should, by now you are thinking that market is going to fall. Now, in my opinion, if I would love to add something over there, I would love to say that When market has built that buy side liquidity and both sell side liquidity, that also the buy side liquidity has taken, then this is the displacement, right? This is a very nice displacement. When I got that displacement, I can simply think that market is going little lower. How far I don't know, but it will go little lower. So I will start to look for some kind of sell side liquidity. If I get that sell side liquidity, obviously after 7 a.m., not before the 7 a.m. Maybe here I have the relatively equal lows. No, don't look at there. There is no price action. You don't know anything what happened before 7 a.m. So this line is your 7 a.m. You don't know what happened before the 7 a.m. This is strictly restricted for 2024 mentorship. I know it is little difficult for you guys, but there is no ending of learning. So this is my opinion that after taking that buy side liquidity, when my buy side liquidity has tagged, then I got this displacement. Though it has taken that sell side liquidity, I will wait for another sell side liquidity to build. If I get another sell side liquidity, maybe that will be my opportunity to take sell. Because I got that displacement, it will use the CB now and it will fall at least until some certain level. So here the important thing is your CB. You are going to mark the CB. CB, what is CB? Sell side imbalance, buy side inefficiency. That means the down close candle which has made the fair value gap. So I'm going to mark that fair value gap. Here, this is the fair value gap. This is the CB, okay, which with this displacement. Now I really would love to talk about something which I have also learned. Sorry, not learned. I have already explained this long time ago when I showed you the 15-second chart over there. Someone just told me I did it wrong because ICT marked that candle high, that candle low. That is the CB. He told that I was rebranding. So I want to tell that guy, here I didn't do the wrong thing, brother. Today ICT told this is not your CB. Your CB is going to be from there. Sorry, that candle open to until that candle low. Why? Because I have a very little imbalance over there. Look, I have a very little imbalance. So from that area, from the low of that imbalance to until this area, this is my real sell side imbalance, buy side inefficiency. In other words, this is my bearish fair value gap. It should be from there, not from here. Okay, not from that candle high, that candle low. Yeah, this is the separation, but you are going to mark it from here, from the low of that volume balance. That is going to be your CB. Now, when you see that market reach until that area, then it fall, right? It fall. After falling until that area, then market started to go higher again. Now, when it came around that area, I would love to mark this low and that low. They are now relatively equal lows. I have the sell side liquidity now. Okay, now they are the relatively equal lows. When market is reaching higher, I would love to mark the old high. Remember yesterday, old high and the inefficiency. Here, this is the CB. I would love to mark that CB now. So from there to there, and I would love to change the color over there. That CB. I have also this CB. I would love to add here about myself. In my opinion, this is the entry fair value gap. This is the breakaway gap. Okay, so don't get confused. I don't want to add my things over here. I would love to explain the ICT things only. So here you are going to mark every kind of CB. So first I have this CB, then I have that CB, that CB. Why this two CB is important? Or sell side imbalance, buy side inefficiency. Okay, CB is SIBI. CB, sell side imbalance, buy side inefficiency. You are going to mark them because market left the sell side liquidity. First, market has taken the buy side liquidity, displacement. This is the fair value gap. When market trade that fair value gap, do you have the sell side liquidity? No, you don't have. So are you going to take sell from there? No, you are not going to do that. Instead, you are waiting for building a sell side liquidity. Then market has made this sell side liquidity or relatively equal lows. Now you will start to look for CB again. At the same time, you will start to look for old high. That means a swing high. Why the swing high is important? Because above the swing high, there is a buy stop, right? There is a buy stop. So market is going to take that liquidity. At the same time, it is going to trade the CB which is formed in that specific area. So market has taken the liquidity, trade that area, fall. Where did it fall? To that specific sell side liquidity. Now you can take the entry maybe from there, that fair value gap, and cover that CB, then target this sell side liquidity. That can be your trade. It can be your trade, okay? So this ICT didn't tell that, but I'm just explaining that. Here he talked about the optimal trade entry as well. That means this low, that high. You will just mark that range, and then you will mark, the optimal trade entry level. Then you can take the entry depending on that. This is also the 22 YT model. Market has taken the buy side liquidity. This is the market structure shift, fair value gap. Market has traded that fair value gap, fall until the sell side liquidity, relatively equal lows, whatever you would love to use, you can use that. I want to come here one more time, but before coming here, I would love to add one more information. Write it down in a marker pen. Okay. In ICT's model, whatever you are going to use, it can be a fair value gap, it can be a order block, it can be a breaker block, it can be a rejection block. Maybe it is some kind of whatever PDR you are going to use, it has a inversion form. That means inversion fair value gap. There is a inversion breaker block. There is a inversion order block, rejection block. Everything has an inversion fair value gap. But ICT told, make sure that you are not, You are not rushing to use that inversion things, because you need more experience to use that inversion things. Okay, so right now don't focus over there, but here I would love to explain some other price action around that area. Why market reach until that area, until that level? Because when this run happened, first after 7 a.m. market has built that buy side relatively equal highs, this high and that high, they are relatively equal highs, which has been bagged over here. It has been taken over there. When market went higher, then displaced. Okay, it displaced. It changed the bias. You will look for your first fair value gap. Look at this fair value gap. Simply, if you are thinking about ICT's normal model, 22 YT model, maybe you are seeing that market has taken some kind of sell side liquidity here. This is your market structure sheet, fair value gap. Market tapped to this fair value gap, then went higher. That means you are not giving priority to the time when it is happening after 7. After 7, market has taken that buy side liquidity, then the displacement. When I got that displacement, this fair value gap, before getting that displacement, when market went higher, first take the buy side liquidity, right? After 7 a.m., first market has taken that buy side liquidity. You are not going to think that this fair value gap is going to hold the trade and sending it higher. No, this is going to be your inversion fair value gap. Mark that inversion fair value gap, the first fair value gap before taking the liquidity, and extend it to your right. Let me change the color. Mark that fair value gap and extend it to your right. Why it is too? Okay. Extend it to your right. Now, I hope that you got an idea about the inversion fair value gap. Obviously, I'm going to make the inversion fair value gap video, but before making that video, I'm gonna ask you guys, do you really want that or not? Okay, because I need to your confirmation that you are not going to confuse me by asking some irrelated question about that video. That is another matter. I will talk about that later to my Twitter. But here, this fair value gap is going to used as an inversion fair value gap. So when market went through this fair value gap and then come back again to that specific area, what is that area? Inversion fair value gap. Trade that constant encroachment of that inversion fair value gap, then fall. What else do I have? High, low, higher high. The lowest down close candle is your breaker. Now the breaker is from there to there. This is your consecutive breaker block, but the most sensitive one is your breaker block. This one. Why it is the most obvious breaker block? Because after 7 a.m. here the time is the most priority, is going to get the most priority. After 7 a.m. market has taken the liquidity. Obvious buy side liquidity it has taken. Then market fall dramatically with a displacement. This is your breaker block. So you are going to refer that breaker block, but you are not going to push your button from that low of that breaker block. Why? Because now you are learning deeper price action. Here you have the inversion fair value. That means market has an intention to trade until that inversion fair value. Here I would love to add something else. When I talked about when market is falling, I don't know why it is falling, and I told that when I'll be around that area, I will add something. So here this is the time. In AM session, market has an intention to trade the London range. So you can see this is the London low, the London session low, and maybe there will be some kind of London high. So from 2 to 5 AM or around 6 AM or whatever it is the London low, maybe until the 5. Where is the 5? Maybe this is the 5. So this is the low. Okay, this is the London session low. So market has an intention to trade the London range around the New York session, AM session. Okay, so in that type of situation, maybe until this low, because this is the 5 AM low, maybe until this low, you can think that market is going to fall. Maybe until that, you can think like that market is going to fall until that area. ICT didn't tell that. I just added it over here to make this video give more clarification, little more clarification. You can think like that way. As ICT told, the AM session has an intention to trade the London range. I hope that it will be insightful for you. So I was talking about this breaker block. So when market will tap to this breaker block low, you are not going to take the entry. If you want to take the entry from there, no worries. You have to put a stop loss just above 1 or 2 tick above that high. Now here I have a confusion because sometimes there is a mohawk. I really don't know how I can actually put my stop loss just above that high, because mohawk can go little higher above that breaker block. Maybe ICT use the mohawk for the lowest down close candle here, this one. Maybe he used this candle for the mohawk, not the consecutive candle. That is the different thing. Maybe in future when ICT will make more episode about this 22 YT model, that will be clear. Okay, so it has traded that breaker block, that CB, also most importantly that inversion fair value gap. After trading that, market fall, market structure shift, fair value gap, optimal trade entry, 22 YT model, whatever you want to use, no worries, you can use anything over there. Then market fall again. Here it fall again. Now over here I am going to talk about the thing when your market is falling, where your eye should be cast, where your eye should be stuck. Every gap, sell side liquidity, every bearish fair value gap, and you will extend that to your right. Every gap you will extend to your right. Okay, something like that. So here this one, then not this one. Okay, this is the inversion fair value gap, not that one. CB, sell side imbalance, buy side inefficiency. Here I have another one around that area, so I would love to mark that one, and I would love to extend it to my right. Now I'm going to mark the 8 AM, and I would love to add something, and let me mark the 9 AM as well, because all of them will be important. Now around 8 AM you will start to think the same thing. What do you mean by that? It's the same thing. Around 8 AM you can use the price until 7 AM. Okay, so around 7 AM I told don't use any kind of price action over there. But when you are in 8 AM you can use the price until 7 AM. So you will look over there from that area. If you see any kind of sell side liquidity, relatively equal lows or relatively equal highs. As you can see, there was no relatively equal highs, but there was a relatively equal lows here around 8 AM. So you have now relatively equal lows. Market has gone above that high. You are reading the price action from 7 AM. You saw that market has taken the buy side liquidity. It is bearish and it is actually falling. So this relatively equal lows you can use for any kind of direction or something, smooth highs or smooth lows, whatever you would love to mark. This is up to you. I'm not gonna say that which you are going to look for, but as per ICT you should only look for relatively equal highs and relatively equal lows. As you have this relatively equal highs, in my opinion you should only look for relatively equal lows. So when market is falling, every single time market is going to refer toward the CB. How far it will fall? we will talk about that. How far it can fall, we will talk about that after a little bit. Okay, just after the little bit. Now, if you want to use any kind of information before 7 a.m., ICT told you will only refer the London low. Okay, so this is the low around the London session, not exactly the kill zone, but after the kill zone, you can see this is near about 540. Still, this is the London low. I will say until 6, it is the London. I will say this is the London session from 1 to 6. So, if you want to use any kind of level before 7 a.m., you should refer either the London low or the London high. That means that can be the highest run for the fall. How far it can fall? Maybe until that London low. And that is the only level you should look for before 7 a.m. Without that, please don't use that things. Instead of that, you are going to use the fib from there to 7 a.m. low. Okay, so there. Standard deviation. I'm going to mark those standard deviation over here. As you can see, ICT showed that -2 standard deviation until that -standard 2 deviation, but I would love to mark until -3 standard deviation. Okay, this is my one, but if you would love to use until -2 standard deviation, it's up to you. So here, this is one level. Let me mark it by red. Then to the around 8 a.m., you are going to use the same standard deviation, the highest high and the low around the after 8 a.m. Okay, so after 8 a.m. So this is the low. I guess it should be that low. This is the 8 candles. Okay, so over here, this is also the line of -3 standard deviation around that area. I'm going to use that on around 9 a.m. the same thing. I will talk about this 9 a.m. don't worry. So I'm going to use that standard deviation from that high to until the low. So what is your lowest low? I guess this is your lowest low. Over here, it reached until, you can see it's near about very near to -1 standard deviation. So I'm just going to mark that standard deviation. So this 3 line is actually the standard deviation. You can use those 3 line or standard deviation from every single time frame from 7 to 8, 8 to 9, 9 to 10. You can use that standard deviation to predict the lowest low, how far it can reach. Also the London low, also the standard deviation if you want, how far it can reach extremely. Now around 9 a.m., what you should look for. Here around 9 a.m., what you should look for. You have the data now until this area. Until that area, you have the data. And you can see this low and that low. They are relatively equal lows. So I am going to mark that relatively equal lows. You can change the color if you want. And I have the relatively equal highs over there. So this high and that high prior to 9. Okay, so you are allowing to use the price until that level, that 7 a.m. So you have this buy side liquidity. Do you have any other buy side liquidity around 9 a.m.? So you are here, not there. You didn't see any of this price action yet. Nothing. Okay. So until that area, do you have any other buy side liquidity? Now, as you can see that you really don't have any other buy side liquidity except that one. Obviously, you are going to mark them from both 15-minute chart, 5-minute chart, and 1-minute chart. I believe that you are not going to get anything from 15 or 5-minute chart. If you get, please mark them. I'm going to use this 1-minute chart as my ICT only use that 1-minute chart. So this is the buy side liquidity. This is the sell side liquidity. What you should look for. First, market has taken the buy side liquidity, right? It take the buy side liquidity, trade that CB. Specifically, it went until that area, that CB. Okay. Remember, this is the CB. Every CB I marked and extend it to my right. Every single CB I marked and extended it to my right. It reached until that area. Are you going to trade? No, you are not going to trade. You are just reading the price. You will push your button. As I told at the first episode, you will push your button wherever you will feel confident. Okay. So it has taken the buy side liquidity. When it has taken the buy side liquidity, what it should look for? The sell side liquidity. Remember here, taken the buy side liquidity, took the sell side liquidity. Here, taken the buy side liquidity, not relatively equal highs, the single high. Then take the sell side liquidity. What it has taken first? Obviously the buy side liquidity. Then it takes the sell side liquidity. Here, it has taken the buy side liquidity. It is going to take that sell side liquidity, relatively equal lows. Now, you will be able to find some kind of setup over there. I'm not gonna tell that, but if I would love to add something over here. Now, ICT didn't show that. I'm going to show that because I would love to add that. Remember the inversion fair value gap? What ICT told, relatively equal highs has taken the first fair value gap. That is going to be your inversion fair value gap. Here, relatively equal highs has taken. Where is your first fair value gap? This is your first fair value gap. Just mark that one. What is that? Your inversion fair value gap. See this inversion fair value gap? You know the context. If you don't know the context, it's not going to help you. Here, around that area, first market has taken the buy. See this buy side liquidity has taken. This is your first fair value gap. I'm going to mark that first fair value gap around that area. This is the first fair value gap. Okay, over there. Then this is the candle which has closed below this fair value gap. Look, this is the candle. Tap to this fair value gap. Boom, inversion fair value gap. Yeah, obviously ICT didn't explain that inversion fair value gap, this one, that one. I will show you more inversion fair value gap, don't worry, by using the same concept. But remember, ICT didn't show them. I am just using his concept, the way he explained that one specific one. I'm gonna show you every single one I can see. This is the inversion fair value gap, same concept. Here is the inversion fair value gap. Press tap to this inversion fair value gap, boom, take that sell side liquidity. Then market took a lot. I mean, it went a lot. Depend when market came until that area, it has taken that London low. Depending on your bias or anything, you saw that you have the relatively equal highs here now. Now I'm going to remove those fair value gap. Oh, by the way, I would love to add one more thing. When market actually took that sell side liquidity, then where did it came exactly? After that displacement, I would love to refer here. After the displacement, okay, market went higher again, fall again. When market went lower, after that displacement, market went higher. Where did it came? Look at this bearish fair value gap. Mark every single bearish fair value gap until you are thinking that market is falling. This is the bearish fair value gap. Body closed, I mean body respected that bearish fair value gap, but specifically it tapped to this bearish fair value gap, to that low, specific low. Okay, so it actually trade that low, then it fall. Now I'm going to remove this one, that bearish fair value gap, those bearish fair value gap. I'm going to remove all of them. Okay, this bearish fair value gap, I would love to remove them. Now it has taken that London low. By anyhow, maybe you know that now is the time to reverse, because market has now relatively equal highs. Where is your relatively equal highs? This high and that high. Look, this is relatively equal highs. You have the buy side liquidity now. Here, let me just change the color. This is now your buy side liquidity. Now, for anyhow, you know that market is going for that buy side liquidity. This is the run which has taken the liquidity, right? All of this liquidity has taken also the London low. So where is your first fair value gap? I mean, what do you mean by first fair value gap, brother? When market was going higher, it was going higher to take the buy side liquidity. See this fair value gap? It was going higher. Maybe there is a fair value gap. I don't care. This is the first fair value gap. I mean, when it is going higher, the highest fair value gap. When it is going lower, the lowest fair value gap. This should be your inversion fair value gap. Now you can see here, this is your inversion fair value gap around that area. Here, this is a very small fair value gap though. I don't like to mark those type of small fair value gap. It's my problem. I really don't like to mark those type of small fair value gap. But yeah, obviously you can use that in fair value gap as your inversion fair value gap. But I would love to refer this fair value gap. That is more obvious to me, looking cool to me. I would love to use that one as my inversion fair value gap here. Okay, so it tapped to this inversion fair value gap. Boom. Where? That buy side liquidity, right? This is the buy side liquidity. Then market came here until that area. Did it make any kind of buy side liquidity at that area? Where is your time frame? Until 7. You are looking until 7. I'm going to mark that high and this high. Now they are my relatively equal highs. I'm going to mark them over there. After 9, did market left any sell side liquidity, relatively equal lows? Did it left any kind of relatively equal lows? See this low and that low. They are relatively equal lows. Market has taken that relatively equal lows. Instead, that relatively equal lows, where did it trade? Exactly where did it trade? Where did it trade? See, to that specific inversion parabolic gap. It has taken that relatively equal lows, went higher. When it went higher, where should be your focus? Where exactly should be your focus? See this parabolic gap? Your inversion parabolic gap. Now, market ICT didn't talk about this. I'm just adding them for your better understanding. This is your inversion parabolic gap. It has taken that low. This is the liquidity run. Market went higher, tap to this parabolic gap. This is your buy side liquidity. Take your entry over there, then cover this one. This is the breakaway gap. This is your breakaway gap. Why it is breakaway gap? That is different matter. Then market has taken the buy side liquidity. So guys, this is all about ICT's episode 2. I believe that in this video you got something. It can be a little longer video, I don't know. If you think it is insightful for you and I should keep making those summarizing or wizard version of ICT's 2024 mentorship videos, then don't forget to give me the thumbs up. Don't forget to subscribe to my channel, and don't forget to write it down to the comment box that brother, please keep it doing. Give me your true opinion. No, you should not do that. You should do that. Make it like that way. Make it like that way. So give me the advice. Okay, I need your true feedback, because that will help me to make this more easier to understand. I need your feedback, guys. I hope that it will help you a lot. Otherwise, until the next video, cheers.